Okay, we're going to get started. It's 12 o'clock. So I just wanted to welcome everyone. My name is Bethany Lawler, and I am the Associate Director of Partnerships in the Office of Alumni Relations. I am also assisted here today by my colleague, Jovan Kafua, who is a Program Coordinator in Alumni Relations. So welcome. This is our second webinar held in 2017 in conjunction with our benefit partners. This one is featuring better money habits through our partnership with Bank of America. To begin, I want to ask all of you participating to type your full name, class year, and where you're tuning in from in the chat box, so we have a better idea of who is joining us today. I know some of you have already started doing that, which is great. Today, I'm thrilled to have Misty Hadzima, Senior Vice President of Enterprise Marketing for Bank of America's Better Money Habits program, joining the Northeastern community to help us make sense of personal finance topics like budgeting and saving. Whether you're completely clueless about personal finance or looking to brush up on your financial knowledge, Misty has designed this webinar for you. So I look forward to learning about these financial tips and tools alongside you today. And Misty, you can take it away.
Thanks, Bethany. Hope everyone can hear me. Are you able to pull up the slides for us? While you're doing that, I'll just sorry. Oh, there we go. Perfect. So I'll just give you a little bit more information about myself. So I've been with Bank of America for 15 years, right out of college. And I have been working on Better Money Habits since we started the program in 2013. And I'll give you a little bit more knowledge and understanding of what Better Money Habits is. It's a resource that's there for you and your family and your friends and your communities to help understand financial topics such as budgeting, saving, and student loans, which we'll touch on today if we have time. So thank you again for sharing this time with us. Everybody knows that it's smart to budget, save money, and pay off debt, but many of us have difficulty doing it. It's a problem that impacts every one of us across all income brackets. We continually look for help through to improve our own financial lives. So during this webcast, you'll receive information that is pulled from our website, bettermoneyhabits.com, to help you learn about budgeting, starting to grow your personal savings, and understanding options to repay student loans. So just a little bit more about Better Money Habits. So let me start with back in 2013, we, Bank of America, listened to our consumers, not just our customers, but consumers at large. And we heard that folks really want tools and expertise to help them address this need for financial knowledge. In response, we partnered with education innovator Khan Academy. I hope most of you have heard of Khan Academy. If you have not, they're a nonprofit with the mission of providing a free world-class education to anyone, anywhere. And they have really honed in on creating online education, and we were able to partner with them and get understand their secret sauce and partner with them to develop bettermoneyhabits.com, which is focused on personal finance online learning. If you haven't heard of Khan Academy, feel free to Google them and go to khanacademy.org. I've just put in a plug for our partner. They have great education resources from everything from math to science to understanding how to do creative development and creative design. So there's a lot of great topics and subjects there as well. So bettermoneyhabits.com, it's free, objective, and accessible for everyone. It is mobile friendly. You can view education resources from videos to content on your mobile device, tablet, and or your desktop computer. It really makes complicated topics digestible and easy to understand, again, inspired by Khan Academy's approach. And it has the content that we've heard from folks that they really want and need. Topics such as credit, understanding credit, saving and budgeting, which we'll touch on today, home buying, renting, debt reduction, and plenty of information there on paying for college and your student loans. The content really lays out the options you have, breaking down all the concepts and helping to visualize different scenarios and outcomes so that you can make the right decisions for yourselves. We know that personal finance is very personal and everyone's situation is different. So the site and the content really tries to lay out all of the information so that you can build the knowledge to make more confident decisions. So let's get started. Let me see, there we go. Let's start with a few facts. So 40% of non-retirees say the lack of savings is their biggest financial regret. And only 50% of us in the United States are actually using a budget to manage our finances. 3/4 of American adults would like help with the basic money matters. And 69% of us Americans cite money as a stress in our lives. And here's some very important savings numbers. 62% of Americans have less than $1,000 in their savings account. And 1/3 of those who have less than $1,000 in their savings account have no savings account at all. And 63% of Americans say they're unable to handle a $500 car repair or a $1,000 emergency room bill. So the majority of us do not have an emergency savings fund. Life is pricey. We all have expenses that we face month in and month out: mortgage, rent, cable, internet service, the daycare bill. So how about your expenses compare with everyone else? Here's a snapshot of some of the ways Americans are spending on their cash. This is from a piece of content on bettermoneyhabits.com today, and looks at how and compares how Americans are spending money. But first, how much money do we have to spend in the first place? The median annual income for those under 35 is $35,000. And the median annual income for the United States at large is just over $46,000. So if you look at all of the expenses we have, that income can go pretty quickly. One of the largest expenses we have is housing. A married couple spends on average 30% of our total income on housing. For those of us who rent, here's a look at the median rent across the United States. And this varies quite a bit, but is still a very large expense. And we have to get to the places we need to go, including work. Transportation expenses not only include your car loans, but it also includes gas, insurance, and public transportation if you're in a city that offers it. It adds up pretty quickly. And we all have to eat. This is a place, though, that we can be smart about how much money we spend. As you can see here, eating out can be much more expensive than cooking at home. And we spend quite a bit of money on staying healthy and preventing healthcare problems. And as we know, in our current environment, these expenses could rise. So all of that, plus the things we want to do, have fun, the entertainment costs we have, giving to charity, and we didn't even touch on paying back debt, your student loans, which we'll cover later, or savings in this. So the expenses do add up, and it's easy to see how our income can easily be spent each month. So first, let's talk about setting a budget. So it's important to set a budget. Whether or not you use a spreadsheet, you probably need some way of determining where your money is going each month. So creating a budget with a template can help you feel more in control of your finances and let you save money for your goals. The trick is to figure out a way to track your finances that works for you. Here are a few steps that could help. So first, you need to identify the amount of money that you have coming in. So keep in mind that it's easy to overestimate your income if you don't think about the things that get deducted from your paycheck, such as Social Security, taxes, 401k, those flexible health spending account allocations. So when you're thinking about your net income, make sure you're paying attention to your net income. That's the number that you should use when creating your budget. The net income is the take-home pay on your paycheck. Step 2, it's helpful to keep track and categorize your spending so you know where you can make adjustments. So tracking your spending is very important. It'll help you identify what you're spending the most on and where it might be easiest to cut back. By listing all of your fixed expenses, those that are your regular monthly bills such as rent, mortgage, utilities, and car payments, those are the ones that it's most unlikely to cut back on, but knowing how much of your money is actually going to those can be helpful. And then if you list out your variable expenses, those are the ones that change from month to month, such as groceries, gas, entertainment. These are the areas where you might find the opportunities to cut back some. Your credit card or your bank statements are a good place to look. They have those itemized, categorized line items that you can use to help with your budget. Also, mobile and online banking is a great way to track your spending. Step 3 is set your goals. So before you start sifting through all the information that you're tracking, make sure you understand what your goals are and what you want to accomplish in both the short term and the long term. Short-term goals should take no longer than a year to achieve. Long-term goals, such as saving for retirement or a child's education, may take a lot longer to reach. So remember, your goals don't have to be set in stone. You can revisit your budget, which we recommend doing at least yearly to redefine and reset your goals. Step 4, make a plan. Use the variable and fixed expenses that you compiled to help you get a sense of what you'll spend in the coming month. With your expenses, you can predict fairly accurately how much you'll have to budget for. You can use past spending habits as a guide when you're trying to track and predict your variable expenses. You might choose to break down your expenses even further between things that you want to have versus things that you need to have. For instance, if you drive to work every day, gas probably counts as a need, but those monthly subscriptions to music or magazines may count as a want. So those differences make a difference when you're making your plan for your budget. Step 5, once you've done all of this, you have what you need to complete your budget. Having documented your income and spending, you can start to see where you have money left over or where you could cut back so that you can put money towards those goals. Want to have expenses, of course, the first place where you look to cut spending. If you can't, you've cut all of the want to haves, you may have to look at the need to haves and determine if there's any that are just hard to part with versus needs. Small savings can add up to a lot of money, so don't overlook the little stuff. You might be surprised at how much extra money you can accumulate by making one small adjustment at a time. For instance, that $5 Starbucks coffee that you get in the morning, if you make your coffee in the morning, that $5 can really add up. Step 6, as I mentioned before, it's very important that you review your budget on a regular basis to be sure you're staying on track. A few elements of your budget may be set in stone, but others could change. You may get a raise, you get a bonus, some of your expenses may increase or decrease, and of course your goals may change as you move through life. So one thing that I wanted to call out is we know, because of the stats that we shared earlier, that budgeting, people know they should budget, but it's very hard to do and take the time to do it. So what we've done at Bank of America is we've recently introduced a spending and budgeting tool within our online and mobile banking apps. It helps you track your spending and creates the budget for you. So it automatically categorizes your transactions into what we found are the top categories that folks are spending in. And we've automatically put your transactions in those categories. You can edit that and shift and change the categories, but it helps you to quickly see the breakdown of where you're spending money, and it helps suggest budgets based on your past spending. So you'll notice that in the colorful ring, the categories are green and different colors. The green ones are those that are more fixed and harder to shift, and the ones in the more brighter colors are the ones expenses that we think are in categories that are more of the wants that may be easier for you to shift. So we provide better money habits information and content in this saving and budgeting app so that you can learn as you're trying to budget and categorize your expenses. So there's this really easy tool, and if you're a Bank of America customer, that will help you set your budget and without little effort. So now that we've talked about how easy it is to spend your money and a way to keep track and budget, let's start talking about saving. Saving money will help you pay for unexpected events or emergencies like the car breakdown that we mentioned earlier, or a medical issue, or for fun stuff like vacations or a night out, long weekend with friends, or for longer term goals like saving for higher education or buying a new car or a home, or very importantly, saving for retirement. The important thing is to get started. Implementing a savings plan that includes regular contributions, even small ones, make a difference over time. With a little discipline and planning, you can uncover some essential practices that you can implement to grow your savings balances and become better savers. Costs add up fast, and building your savings can seem like a pipe dream, but small changes now can yield big benefits later. So these are the 5 basic steps to get started with savings. Think 1% at a time, get analytical about your budget, prioritize your future self, make it automatic, and go slow and steady. We'll break this down. Again, this is content that's from bettermoneyhabits.com, so you can find this, what we call listicle, on the site today. So first, think about starting small. Resolve to put just 1% of your income into saving over the next month. By doing so, you'll flip an important mental switch. Before, you were someone who wasn't saving for the long term, but now you are. That's a key difference, because it's much easier to ramp up your savings if you've already formed the habit. So, however modest, take the first step. Let's say your bi-monthly take-home paycheck is $500. At 1%, you would contribute $5 of your savings fund each pay period. 24 pays equals $120 a year. If you set up automatic transfer for this 1%, you won't even have to think about it. So you could do things, you've probably heard all of this before, but if you bring your lunch to work versus eating out, or cutting back 1 coffee a week, or visit the library instead of ordering those books online or movies online, that could be that 1% of savings just to get started. You may think you have no breathing room in your budget, but take a hard look at the money you shelled out over the past month. Divide every cost into your needs and your wants, and go through your wants. And even the small thing like cutting out the Friday night pizza when frozen pizza could suffice will help you reduce those extra expenses to create space in your budget for regular savings for when those needs actually do arise. For example, it's unfortunate, but emergencies happen when we least expect them. We might need a new car battery or a new water heater. I just recently needed a new furnace for our house. These needs that we have to be ready for them. Saving today will help you not go in debt when these needs arise. So each month you pay your regular bills, you pay your rent, your mortgage, your utilities, your student loan payments, your car payment, but you should add something else to that list. You should add your future self. Commit to depositing a portion of each paycheck directly into your savings account for you, for your children, and don't forget your retirement account. Even a small portion can add up. When you treat savings as mandatory, you make it much easier to stay serious about staying on track. Some ways that you can pay yourself first include direct deposit. So if you have direct deposit from your bank, you can actually determine a portion of that goes into each account. So the majority of it could go into your checking account, but you could commit 5 to 10% of your paycheck that will go direct deposit automatically into a savings account. So that's just one idea for making it mandatory that you do pay yourself first before you look at all of your expenses. If you don't receive direct deposit, you can set up an automatic transfer or manually transfer when it hits your account if you don't have direct deposit. Make it automatic. So those were two ways that I just mentioned that you can make it automatic. But once you've figured out how much you want to save for yourself each month, and you're confident that you'll have enough income to meet your goal, you can set up automatic transfers between your checking and savings account, either mobile or online banking, or do the deposits breakdown that we mentioned. At Bank of America, you can make savings automatic through our mobile and online banking. It's easy to transfer money between your accounts, either one time, set it up as a one-time transfer, or you can set up recurring automatic transfers, and you can have those go from your checking to your savings account each month. Go slow and steady. Saving for a down payment on a house or an emergency fund or even a hard-earned vacation might seem an impossible hurdle, but remember that you can achieve your most ambitious savings goals if you work toward them gradually and in small increments. By forming the basic habit of saving and by sticking to specific attainable goals, you'll lay the groundwork for a lifetime of financial progress. At Bank of America, we have a short-term savings calculator also, which is available in online and mobile banking that can help you do the math. It's simple to do the math. You first start with identifying what you're saving for. Select either an emergency fund, vacation, or a down payment. So set your goals. Number two is determine how much money you're going to need for that goal. It could be anywhere from $1 to $50,000. But understanding how much you need to save is very important. So you enter that in. And then finally, number three, how much time do you need to get there? So when do you want to go on that vacation? When do you need that savings to come to fruition? And you put in either 1 month up to 5 years, and then the calculator will do the simple math of how much money you need to save each month to reach your goal. So now that you've learned how to save, where do you put that money? So all banks provide different ways to save. There are regular savings accounts. These are basic accounts that allow you to easily access your money anytime, online, mobile, as I've been talking about, or via ATM. There's generally either no minimum balance or a low one, plus you'll earn interest. These types of accounts are really good if you think you might need the money soon. Also, please note that there are some fees associated with frequent transfers from out of your savings account. So please be mindful of that. But regular savings accounts are those that are pretty easy to access your money. Money market savings accounts are also easy to access your money. They generally earn a higher interest rate. But they typically do require you to have more money in your account before you will get fees. So if you have some savings already, a money market saving account will probably be the right solution for you. Then there's certificates of deposits, or CDs, and these are definitely higher interest rates than a regular savings or money market deposit account. But your money is tied up over time. So it could be anywhere from 9 months, 12 months, or even longer that you won't be able to get that money out. But these are really great tools if you are saving for a child's education, or part of a retirement savings plan, or really have your sights on a few years down the road an overseas vacation. So now that you've learned how easy it is to improve your savings behavior, hopefully you and your family can save more successfully. So now I'm going to transition into repaying student loans, which is another topic that we have covered on Better Money Habits. Student loan debt is a huge issue in our country. With the rising cost of college, student loans have become the norm in the pursuit of a degree. About 3/4 of students leave school with some kind of student loan debt, and navigating the ins and outs of repaying student loan debt is pretty much a fact of life. Most college grads leave school with an average student loan debt of around $29,000. However, it's important to remember that on the range of debt that you might have, student loans are positive on that spectrum. They can help you build a good credit score by responsibly paying your student loans off over time, and it can help you build and maintain that good credit score. It is important to plan. It's important to have a plan for how you tackle your student loan debt. By setting yourself up for success early on, you'll save money and interest in the long run. So I'm going to talk you through a piece of content that's on Better Money Habits today that is the intro to student loan repayment and really understanding the ins and outs of student loan debt. So there's basically two types of student loans. There's private, which means that your lender is a private institution like a bank, or federal, which means they're issued from the government. Most student loans are some sort of federal loan, so that's what we'll be focusing on today. Now, there are two different kinds of federal loans. There's subsidized and unsubsidized. Subsidized loans, for those who qualify financially, offer better terms. They're called subsidized loans because they're subsidized by the U.S. government, meaning the government actually covers the cost of interest on these loans during various periods of the loan's existence. So you don't bear the full weight of borrowing all this money. With unsubsidized loans, on the other hand, you don't get the same benefits, and you're responsible for the interest on the money borrowed from the day you take out the loan. For example, if you choose not to pay the interest while you're in school, that interest will accrue. Here's a very important term to understand. Accrual. It is when you accumulate from month to month. The interest will be added to your principal every month, and the next month, your previous month's balance will be used to calculate the amount of interest that will be added. So this can cause your principal balance to grow exponentially when you don't make those payments. Grace period. Now, right after you leave school, if you've just graduated, the government might offer you a grace period of around 6 months where you don't have to start repaying your loans right away. This can allow you some time to figure out what's next, whether it's finding the right job or going back to school. During this period, like while you're in school, the government covers your interest on most subsidized loans, except direct subsidized loans that were issued between July 2012 and July 2014. Now let's look at some of the repayment options you have. You basically have 4 options here, and there's more detail on these on bettermoneyhabits.com, but I'll just touch briefly on each. So first, you can pay ahead of schedule, which is great if you have the means to do so. Whether you can, doing so will help you save on interest over time. Or you can pay on schedule, either with a standard 10-year plan or a 10-year graduated plan. The standard plan is basically the default plan for paying back your loans. Your monthly payment is fixed over a 10-year period, and it's one of the quickest way to pay down your loans. With a graduated plan, you're paying off your loan with the same amount of time, but your monthly payments start out small and increase every 2 years. So you need to be sure that you can cover that increased payment at the end of that 10-year plan. You can also pay on an income-based plan if you qualify. This can be helpful if you can't afford to make the monthly payments on a standard 10-year plan. If you're eligible, your monthly payment is determined by how much you earn. If you need to make lower monthly payments over a longer period of time and have over $30,000 in student loans, then the extended repayment plan might be right for you. Under this plan, your monthly payments are a fixed or graduated amount and generally lower and can be made up for up to 25 years. You also may have the option to delay your payment with either deferment or forbearance if you're in a situation where you really can't make payments at all. Common examples of this would be if you have some sort of financial hardship or if you decide to continue your education. A deferment is a period during which repayment of the principal and interest of your loan is temporarily delayed. During a deferment, you do not need to make payments. What's more, depending on the type of loan you have, the federal government may pay the interest on your loan during a period of deferment. If you can't make your scheduled loan payment but don't qualify for deferment, your loan servicer may be able to grant you a forbearance. With forbearance, you may be able to stop making payments to reduce your monthly payment or reduce your monthly payment for up to 12 months. Interest will continue to accrue on your subsidized and unsubsidized loans. You can pay the interest during forbearance or allow the interest to accrue or accumulate. Now, keep in mind that not repaying your student loans or paying your student loans on time is not advisable. Even missing payments can affect your credit score. And after only a few months of missing payments, your loans may go into default, which can have major consequences. By this point, you won't have the option of putting your loans into deferment or forbearance. The balance on your loan can become immediately due, and in some cases, the government can even take your money, the money you make from your employer, to pay off your loan. It can also be really bad for your credit score, so going into default is something you really want to avoid. One last caution about student loans, which I didn't know as we were building out this content: filing for bankruptcy, which can result in forgiveness of some types of debt, does not generally allow for your student loans to be forgiven. So if you know you won't be able to pay off your loan, you should contact your lender immediately, and they can help you review what your options are. There are a lot of options to consider when considering how to repay your student loans. We go deeper into these options again on bettermoneyhabits.com. There's also a lot of really great information on studentaid.ed.gov. So write that down, or Google studentaid.ed.gov, and that there's a lot of really great information there. But we also advise to contact your loan servicer if you're having trouble, and they can walk you through all of the options as well. So I do have a section in here that is another piece that is on comparing the repayment options, and I'll just go through these slides really quickly so we can leave some time for questions. But there's this piece really takes a look at comparing standard, income driven, and extended. So the plan options, as we've already talked about, standard is the default option for federal student loans. It's that 10-year plan. Income driven is if you can't afford your 10-year repayment plan, you may qualify for this income driven repayment plan. And extended is if you have over $300,000 or $30,000 in student loan debt, you may have the option to extend it over a longer period of time to pay less payments. But this has impacts on what your monthly payment is. So your fixed payment could be $50 or more on your standard 10-year plan. Income driven is based on your income, so it could be 10 to 20% of your discretionary income. And extended is either a fixed amount or graduated, where payments are usually lower at first and gradually increase. The repayment period. So this is very important. In standard, you get your student loans repaid in that standard 10 years, which is beneficial because you rack up less interest. Income driven, you can have lower payments for up to 20 to 25 years, and the same with extended. So the advantages. On a standard 10-year plan, it is a shorter time frame, which means you'll generally pay less in interest overall. Income driven allows you those lower monthly payments to let you use more of your income for what you need in your life. And extended helps people who have a reasonable income but are struggling with the high payments due to the large balance. Disadvantages: monthly payments will generally be higher on the standard repayment plan. Income driven, a longer term means you could end up paying more overall because you will be paying more interest. And extended, the extended time frame means you may pay more interest over time in the long run. So just remember, even if you select or are assigned a certain plan at the start of your repayment, you can change it at any time by talking to your loan servicer. Just be sure to make any decisions carefully, assess all of your options, as these can have a big impact on your future life. With that, I'll open it up for questions.
Thank you, Misty. This is Bethany again. We did have a few questions come through, so we'll start with those now. Note if you are still with us and have any questions, please type them into the chat box. There's a little chat icon located at the bottom right-hand side of the screen, and I will make sure that those get answered. So the first question we have is from Dan from Colorado, and he's asking about loans. So in particular, with the Public Service Loan Forgiveness Program, he was asking what your opinions of the program are with Trump being in office now, and do you think those will still continue?
Unfortunately, I'm unable to speak to that. I don't have any knowledge that would benefit the group on that question. My apologies.
Okay, well, he had another question about income-based repayment, which I know you just touched on. And he was asking, what are the disadvantages for opting for income-based repayments? And does this option negate unemployment deferment?
That's a really good question. The disadvantages are really, like, the one thing that you really need to consider is how much interest you'll be paying over time. So if it makes sense for you to apply for a income-based repayment plan because of your current situation, just be aware that you'll be paying more over the course of the loan. And I'm sorry, I didn't write it down. What was the second part of that question? Will that impact unemployment?
Does that option negate unemployment deferment, if applicable?
So I'm unable to answer that question too, Dan. I'm so sorry. You can either go to studentaid.ed.gov. There may be some information there. They have really good comparison information, or you can contact your student loan servicer.
Okay, so the next question we have is from Sumite, and he's asking about saving accounts. He's asking about the different monthly fees that can be associated with the different savings accounts that you had spoken about before in the presentation.
Yes, so there is some information on bettermoneyhabits.com on different fees that different banks may offer. And I will put in another plug for bettermoneyhabits.com. It is a website that is what we call bank agnostic. So it looks across the industry and provides information whether you're a Bank of America customer or not. So it does look at industry wide. So a lot of the most common fees on savings accounts are minimum balance fees. So you have to have a certain amount of money in the account consistently, or there could be fees. The other most common fee is associated with the number of transfers. So if your bank may have a maximum number of transfers that you can transfer money from or take out money from your savings account a month, and that could cause you to incur a fee.
So this is Bethany again. I actually have a question about what you just said about transfers. Is there a limit overall on, I know I have a Bank of America account and I've run into the problem with running out of transfers in a month. Is there, what are, the disadvantages or the rules that the government places on these types of transfers from checking to savings or savings to checking?
Yeah, it's there are regulations that are causing banks to need to maintain savings accounts differently than a deposit account. So I know at Bank of America, I believe the rule is that we have you're allowed 6 transfers per month out of your savings account. If you find that you're needing to transfer more money a month out of your savings account, it may be better to hold it in your checking account.
Okay, great. We also have another question from Sumit about overdraft fees. So he is asking if overdraft fees can affect someone's credit score.
That is a great question, and actually, I don't think, in all of my research, I don't think overdraft fees do impact your credit score. I think that it's paying bills on time. It's your amount of credit, your credit limit. There's several inputs into your credit score, but I don't believe overdraft fees do. Banks, I don't think that banks report overdraft fees to the credit bureaus.
Okay, great. We have another question from Chris, who is asking if the bill payment feature on Bank of America can be used to deposit money to another banking institution's savings account.
I think you can use the bill payment feature. There's also and I apologize. I'm in enterprise marketing, and I'm the lead for Better Money Habits. And I know I do bank with Bank of America, and I do know quite a bit about our products, but I'm not the expert. So I hope I'm answering your questions as best I can. I do know that you can use the transfer ability within your accounts as well. So I do think that you can set up a bill pay to another account, but I do know that you are able to use the transfer functionality.
Okay, so next question is, you talked a lot about savings accounts and the types of things that can be pulled from to add to your savings account or to work towards when building your savings account. What's the ideal number to have in that savings account? I know in the past I've heard like 3 months expenses. Is that still relevant today?
It is. What we like to say is to just get started. So any amount in a savings account is better than zero. But we do think that setting a goal of 3 months to begin with of your income is a good place to be. That will allow you to pay for the majority of emergency expenses that might come your way, or if you find yourself in a place where you're not receiving income for a few months, you'll be able to pay your expenses. So 3 months is a great goal. Continue to build from there. 3 to 6 months would be a good target.
Okay, great. And then the last question that we have, unless we get any more in the meantime, is about new kind of money sharing apps. So what's your opinion on apps like Venmo that allow money sharing between networks?
Yeah, so this is my personal opinion. I think technology is making the ability to get and receive money so much easier. And I think these apps are really interesting. We also are continuing, and banks, in addition to a lot of the fintech companies, are continuing to be challenged to keep up with technology and create more ways that make it easier for consumers to manage and maintain their money. So I think it's great. I think the environment is also challenging all of the financial industry to raise up and do better. And I think, personally, in my opinion, from a marketing standpoint, I really love the environment that we're in today, because I feel like the consumer has the power, because there are all of these options, and technology is creating even more options for managing your money and being able to track and understand where your money is going, and being able to share your money with others, I think is creating this great environment where the power is in the consumer's hands, and our entire industry is having to or getting to create the right solutions to make sure that our consumers are, have the access to the money that they need. That is one of the reasons why we recently launched the spending and budgeting tool, which is I know that I touted it a lot during the presentation, but it is a really cool addition to our mobile banking app and online banking, where it takes all of your Bank of America accounts, and in the future we are hoping it'll pull from all of your non-Bank of America accounts and categorizes all of that expenses and creates that budget for you and helps you understand and track your money. So I'm really excited about the technology and the world that we're in right now. I think it's a great place to be.
Okay, great. I think that's a great way to end the webinar. So Misty, I want to thank you for providing such a comprehensive and fantastic presentation on all these aspects of personal finance. And I also want to thank Jovan, who's with me, ensuring that everything ran smoothly today. To follow up on this presentation, we will be sending a survey. We greatly value your feedback, so please fill out the survey. And within this email, we'll also include a link to the recording of this presentation. So feel free to revisit it and share it with your networks. It'll also be on the Alumni Relations website. If you enjoyed this presentation, there will be one last webinar in this 3-part series featuring our benefits partners. So our Liberty Mutual webinar that will be covering Auto Insurance 101 will be on April 12th at the same time, noon Eastern time. So we hope to see you all there. Thanks, everyone.